Welcome again. Hope you enjoy networking and relationship building. Thank you for joining us for our final session of the day, Risk Beyond Balance Sheets, Redistributing Risk Equitably. While this will close our first day of the summit, don't worry, we have another amazing afternoon of programming lined up for you tomorrow. We are excited to get this last panel started shortly, but first, a quick orientation. Attendees, you will see a chat box and a Q&A box, both directly to the right of this live stream video. Use them to communicate with other attendees and to send questions for the consideration by our moderator. If you're having technical difficulties, check out the FAQs up top for how to get support, or click the red icon in the lower right corner. With that out the way, let's get this session started. Thank you.
Is it me? Sorry. Hi guys, I'm Caren Johnson. I'm the project manager for Underwriting for Good, and I'm going to be moderating this panel. Apologies for the sort of clumsy intro there. Underwriting for Good is the center's digital mortgage lending system. And in a nutshell, we're building a rules engine that would allow for alternative credit to be used when deciding a borrower's creditworthiness. When we first started this project in October of last year, we were a bit nervous on how to do this because it was different, it was risky, it was something that we had to figure out what the best way forward was. And then just a little bit, probably earlier this year, Fannie Mae gave us the best news. They would be allowing rental payment history to be used as a form of credit, looking at a borrower's creditworthiness, which means two things to us. One, we were on the right track at looking at alternative methods of credit. And two, that we now had a way forward. So what we're going to be doing today is looking at risk and how to distribute it equitably, how it affects, models that have already been built, and how we are using it to update models of risk with using real life examples. And I have three brilliant panelists with me. I have Carolyn Koosky, Brian Loeb, and Viraj Patel. And we'll have each one of them introduce themselves and where they work and give a little bit about what they believe risk is. Carolyn, do you want to start first?
Sure, thank you. It is such a pleasure to be here with all of you today. So I'm Carolyn Koosky. I'm the executive director of the Wharton Risk Center. We're a research center associated with the business school at Penn. And the center has been around for over 35 years doing work on risk management, risk communication, and risk finance issues. My work in particular has focused on natural disaster preparedness and recovery, and now increasingly how to address the escalation in these risks as the planet warms. So I work a lot on insurance and risk transfer markets, and I'm particularly focused on how to harness insurance for social good. How can we use insurance to help disadvantaged households and communities recover better? How can we use it to achieve our climate adaptation goals? And how can we use it also for things like promoting conservation and restoration of ecosystems? So that's my main focus. And thanks again for having me.
Thank you. Brian, do you want to go next?
Sure. Thanks, Caren. So I'm Brian Loeb, and the Federal Home Loan Bank of New York is one of 11 such home loan banks across the country, divided into districts. We're a cooperative of our members, and those are the banks, credit unions, CDFIs, and insurance companies based in our district, which is New York, New Jersey, Puerto Rico, and the U.S. Virgin Islands. Those members borrow from us. And some of that borrowing is done at a discount to fund those institutions' community development lending. And then we in turn use a percentage of our annual profits to run an annual competitive grant program for affordable housing, which comes in as gap financing on much of the affordable housing acquisition, new construction, and rehab projects throughout New York State each year. So I'll be about our perceptions of risk as viewed through that program and some of our others. I just want to stress that I'm speaking in my own capacity about risk and opportunities, and not on behalf of the bank. So thanks so much for having me.
Thank you. And Viraj?
Yes, thank you, Caren. Viraj Patel. I'm currently the global head of a product for S&P Global Market Intelligence. S&P Global Market Intelligence has a risk division within it. Within that risk division, I head up our credit risk analytics product suite. Credit analytics is a suite of data analytics and workflow tools that facilitate the assessment of unrated counterparties from a corporate credit standpoint. So obviously, you're likely all familiar with our sister division, S&P Ratings. I'm in a different division from S&P Ratings. But Ratings basically rate globally maybe around 10,000 companies. But corporations have exposures to hundreds, if not thousands, or even tens of thousands of corporate counterparties. So it's essential for them to be able to understand the credit quality of those counterparties, and our data analytics and workflow tools help facilitate that. I've been with S&P for about 15 years now, and I'm very excited to be on the panel with the rest of the folks here. And thank you, Caren, for having me.
Thank you. And I'm very, very excited to start. So the first question is for Viraj and Brian, but Carolyn, I'd love for you to weigh in on it a little bit later. So the three work in different areas, and you're all evaluating and distributing risk. What are ways in which you approach evaluating risks in your respective fields? And Viraj, why don't you go first?
Sure. Yeah. Thanks, Caren. So as I mentioned, our tools are generally used to assess corporate credit risks or counterparty credit risks. So the way we kind of look at it today is really from a fundamental perspective. We kind of look at two core components. I would say one is the binary decision of whether you will get into any type of counterparty exposure with a particular organization. So pretty much a binary question, answer, yes or no. And our underlying tools allow you to address that decision-making point based on your decisioning criteria and based on the levels of risk appetite that you have within your organization. I think the other facet of risk that we also look at is the secondary component, really around pricing the risk level correctly, right? One decision point is saying, right, I think that this company is resilient enough or creditworthy enough for us to get into a relationship. But then let's say I am giving a line of credit or originating a loan. How do I price that risk correctly? So that's really kind of, two components that we look at the risk spectrum from, with some further ones that we're kind of going into, which I'm sure we'll have the opportunity to discuss later.
Thanks, Viraj. And we, in our program, we think about risks from kind of three perspectives. One, you could say, is the risks that the developers of affordable housing and the sponsor organizations for our projects are seeking to address in their communities. Whether it's the likely climate impacts or other things which we may get into during this discussion, and identifying to what extent our resources and our program is a good fit for their projects and the way they plan to go about their needs. Or the second perspective from which we think about risk is to our members, and what risk our members, again, that's primarily banks and credit unions, what risks do they perceive in the markets they serve, and are our products alleviating or compounding those challenges? And the third perspective is for us internally, what risks are we taking on in running our program, which is heavily regulated? And are those risks that we're taking on commensurate with our role in the funding landscape? Are we assuming too much burden and exposure given what we're expecting to achieve, the impact we hope to have? So hope to illustrate some of these as the discussion goes forward.
And Carolyn, do you want to offer any thoughts on that as well? I feel like you'd have a few more to add.
Sure, happy to. So when we're looking at risks, we're looking at the economic and financial impacts, often of different climate perils for households and communities. So that's going to be looking at how extreme events like flooding and storms and wildfires are changing. And since climate change is worsening these types of events, changing their frequency, their magnitude, their timing, their duration, historical data is often no longer a useful guide to what we'll see in the future. So for example, I'm here in Philly, and both Philadelphia and New York City suffered really serious flood damage a month or so ago from the remnants of Hurricane Ida. And if you look at extreme rainfall events like that event, they've been trending upward for our region. And so we can expect continued worsening of these intense rainfall events that cause damage. And since the past is no longer a good proxy for the future to think about these disaster risks, the insurance industry and others often make use of different simulation-based models that can incorporate some of the changing climatic conditions to give us some insight on how risks will evolve as the planet warms. But to be clear, at our center, we're not sort of focused just on the hazard itself, but on that ultimate financial impact. So what does that change in the hazard mean economically and financially for a household or for a community? How much damage will be caused? What expenses are going to need to be covered? And that depends on the location, on the types of buildings, how and where we build, on preparedness and emergency response measures. And then also, what are the resources available that will determine overall impacts? Is there insurance in place? Are they getting disaster aid? Are there other sources of recovery? Do people have savings? Do they have access to credit? And so we work on this from the household, sometimes small business and community and municipal perspective. And all the research shows, right, that lower income households and communities are disproportionately harmed and suffer disproportionate economic impacts. So, but understanding those dynamics can then help us decide what type of interventions are needed.
That makes sense. That makes a lot of sense. Now, I'm curious, and this question is for Brian and Carolyn. What ways are your fields adapting to take on these unprecedented risks? Because there is more risk and it's changing, just like you mentioned. But how are your industries changing? And then Viraj, I'd love for you to weigh in on that as well. Brian, do you want to start us off?
Sure. So we think about, let's take the climate risks and the disproportionate climate risks faced by low-income residents that Carolyn mentioned. We see those like others, not just in extreme events, but on a day-to-day basis, the impact that folks feel on their energy expenses, which are also disproportionately higher due to climate for low-income residents. And so one way that our program and the state housing finance agencies and other large funders of affordable housing have tried to tackle these risks is by incentivizing kind of green building innovation. And our program explicitly has a category to reward projects in this area as of this year. And in particular, the program's Passive House and Net Zero, we're encouraging affordable housing projects to make this extra investment, learn about these design techniques, and pursue kind of a higher standard, like a REACH standard in terms of their green building activity, because we know that it has an impact not only on the climate, but also on the residents' daily lives. And so that's one way that we, using our unique role as a gap funder, are trying to push the envelope, improve expertise, bring down costs in the industry to make it more standard for developers to think about the rare and day-to-day impact of climate on their residents.
And Carolyn, do you want to offer your thoughts on that as well?
Yeah, sure. As I said, I do a lot of work in insurance, and as climate change worsens extreme events, insurance is becoming ever more important for people's recovery and for their resilience. And the reason for that is that many households don't have other sources for the needed funds for recovery. So most Americans don't have enough liquid savings to cover the, say, tens of thousands or even hundreds of thousands of dollars after a serious disaster event. They might be locked out of credit. We've seen we've looked at even the disaster loans that the federal government makes available. And as income declines, the rate of denials for those go up. So lots of households can't count on a loan. Aid is often wildly insufficient or way too delayed to actually help with needs. And so that leaves insurance. And yet these same forces that are making it more necessary are also making it harder to get the needed insurance and making it more expensive. And so some of these are going to be public policy questions. For instance, we've been hoping that Congress passes a means-tested assistance program for the federal flood insurance program, right? So that folks who need that flood insurance the most actually can afford it. But we're also seeing innovation in the insurance sector and in the private market in response to these kind of pressures of climate change. One approach that's starting to be used more frequently and sort of explored for climate risks is something called parametric insurance. That's a type of insurance that pays based on a measure of the hazard itself, not based on the damages. And so it can be a lot faster because you don't need things like loss adjusters and so forth. And so you can often get payment in a matter of days, which if anyone has looked at the timing of other sources of disaster recovery dollars, that's like really fast. And the dollars are very flexible to be used for whatever kind of disaster expenses there are. Of course, that's not useful everywhere. It's not a substitute for having like something like homeowners insurance. You still need that indemnity coverage, but there are places where it can be helpful. And one is helping provide insurance coverage and financial resources to households and communities that have previously been locked out of the insurance market. And so we're actually working on a pilot right now with the Center for New York City Neighborhoods and the Mayor's Office of Climate Resilience on a model that could harness parametric flood coverage in order to pay for disaster assistance to those most in need after a bad flood. So those are some of the innovations you're starting to see.
And can I ask a quick follow-up question on that?
Of course.
How does parametric insurance differ from flood insurance?
So the flood insurance that's provided, say, through our federal flood program, which is most residential flood in the U.S., is what we call indemnity-based, which is actually most insurance that people have experience with, your auto insurance or homeowners insurance. And that means that someone comes and actually assesses the damage, and you get paid exactly what that damage is. And so lots of times that type of insurance is really important, but it does also slow everything up. And there's often lots of battles then over those adjustments and that loss adjusting process. Does that help?
That definitely helps. I have heard of it, and I want to make sure that I'm making it makes sense in my brain, because we're talking about changing the goal and that sort of thing, but I'm also thinking of it in terms of how to afford these, how a homeowner might afford these different additional expenses. And Viraj, I want to bring you into this. I know you're not on the homeowner side. I know you're on the business owner side or looking at businesses, but have the goals changed in how you're assessing businesses as well with the changing?
I mean, they have. Right. I mean, we face unprecedented risk from climate change, and that only doesn't take shape in the consumer landscape, but also in the corporate landscape. So as I mentioned earlier, kind of fundamental risk is the angle that we generally tend to look at corporate credit risk from. But we're, avidly moving into the kind of ESG space. Kind of one of our first forays into that is looking at transition risk. So you may have heard that many companies have now pledged kind of zero carbon, right? And their journey to zero carbon by a certain date. But to get to that, there are certain capital expenditures that companies need to make. Now, as they are transitioning to that zero carbon footprint, what impact does that have to their credit quality? There could be a significant impact depending on the level of those CapEx expenditures they need to make to meet those zero carbon goals. So we have a suite of tools that really look at, various market-based scenarios that then allow you to fundamentally, from a bottom-up standpoint, look at what the transition risk would be over the next 20, 30 years, or whatever time horizon a company is looking to get to net zero. A component of that, which actually plays into something Carolyn was discussing earlier, a component of that is also the ability to measure physical risk. of these corporations. They may have production, manufacturing, various offices in various locations, and understanding the physical risk impact within those geolocations, whether they're prone to flood, fire, storm hazards, is something that really needs to be understood at a granular level. And not only the fact that, hey, this building or this manufacturing center could be within a flood, fire hazard location, but what is the tangible impact that if an event of that nature occurs, what is the tangible fiscal impact to the company itself? So we are working within S&P on various models around understanding the physical risk landscape and more importantly, quantifying the impact of these events on corporations. But our tools could be used, in the insurance industry as well, to really understand what the physical risk of these locations are. It's as simple as putting in a geolocation, and then we run our model and we break down the probabilistic risks in those areas and kind of show them to you in a kind of efficient way. So it's really easy to understand what types of risks certain areas may be prone to.
So when you were building the model, what exactly were you hoping? Were you specifically saying, okay, I'm going to figure out the risk of sorry, I'm losing my train of thought because my brain is swirling. But I mean, what went into building the model? What went into sort of shaping it?
It's a two-step approach that we as an organization are still undertaking. Most of this modeling effort is happening within our Sustainable One division, which is our kind of ESG vertical within market intelligence. But I think there are two main facets there. The first is really understanding what physical risk attributes a location is prone to, right? Without understanding that, there's really no way of understanding the relative impact of those. And then the next piece is really trying to assess that material impact to the business or the operation at the time. So there are really two different problems to solve. We've solved the first one. We're working on solving the second one, which is really the material impact piece. But we're using various historical data sets where we can. That is a good predictor of the level of damage that these events cause. Historical events are a good predictor of that, as well as using, certain alternative data sets that allow us to kind of assess that measure. So in tandem, you can both get an assessment of physical risk, but also if something happens, the potential impact of it, which then allows you to build into credit models to then assess the risk to the underlying organization as a whole.
And I'm glad you brought up data sets, and I'm glad Carolyn, Viraj, both of you brought up data sets, because I want to talk about data. So our priorities are switching and changing because we have so much new risk that we have to assess. How does it change the needs for different kinds of data? And are there specific kinds that you're looking at? Have you had to throw out all data and completely rewrite it, or are you just adapting the data sets that you're looking at? Viraj, if you want to start us off.
Yeah, sure. Thanks, Caren. Yeah, I mean, it's something we've spent a lot of time on here at S&P. Obviously, the traditional way of looking at corporate credit is still in some way, shape, or form there in terms of looking at the fundamentals of a company. I don't think that will ever change. But I think what is changing is pulling in other aspects of risk, right? Things that naturally you wouldn't really look at, right? An example of that would be, let's say, private companies, for example. They file on an annual basis if they're mandated to file at all. Now, from the point they file to the point that, you may be exposed to that counterparty as a, from a supplier-customer relationship standpoint, how do you understand what's gone on from the last time they file, right? That's stale information. And, leveraging that in credit models could give you a forward-looking result, but a lot can change, right? As we know in the world today in a very short amount of time. So, we're looking at alternative data sets, such as social media to garner sentiment on companies, right? The use of social media skyrocketed in the kind of era of the pandemic. but it is a good, view into how the public looks at a specific company, right? Are they following the company? Are the review levels going up? Are the number of followers increasing, in a substantial degree? All of these could be good primers of kind of sentiment and credit quality, right? And good predictors of growth for companies. So we're looking at alternative data sets such as that. We're also looking at, for traditional brick and mortar companies, right? Obviously, now that the kind of pandemic has to some degree subsided, but there is some semblance of normalcy going back. How do we track the comeback of these kind of brick and mortar companies, right? So for that, we're looking at things like foot traffic data, right? Are certain areas increasing in foot traffic? Are they declining? Are they staying stable? That again could be a good primer and a good view or leading indicator into performance and credit quality in the future. And I think one last one that we're looking at as well is more from a supply chain standpoint, but looking at supply volumes that are being shipped across the world. So bills of lading have to have what's being shipped, how much quantity is being shipped, and by looking at that data, you can really start to understand how the global supply chain is working. And if you start to see deteriorations in supply of certain raw materials, certain types of equipment, certain types of materials that are required for manufacturing, you can really start to now put together a model of where core impacts are going to be within the more global economy. So these are some of the alternative data sets that we're looking at to really get us a better understanding beyond just looking at the balance sheet, right? Which is a more traditional way of looking at risk.
And Carolyn, do you want to weigh in on the data sets that you're looking at for your pilot?
Sure. I think it might be helpful to kind of zoom out a little bit about the types of climate data and how it's changing. I think judging by the number of startups in this space, there's, I think, a growing thought that much more climate data is going to be needed by firms and governments to navigate the impacts that are now upon us and only going to get worse. And so what I maybe wanted to highlight is what I think is an important emerging issue, which is that there's going to be a need for better understanding about model uncertainty and the differences between models and what certain models can and can't do and what certain data as inputs does in terms of improving our understanding in our models and what it doesn't. So for example, a hydrologic model of flooding is quite different than a downscaled climate model, for example. And I think while we're seeing a huge explosion in models and data capabilities, I think we need to invest a little bit more as a society as well in educating users so that they know which models are fit for their purpose and which aren't, so that they're not misled by trying to apply the wrong kind of data apply a model to the wrong kind of problem that it's not designed for, right? As well as being able to better evaluate which ones on the market now have been, rigorously tested and have more credibility than other ones. And it's also, I think, helpful and harder for many users to realize, that old saying, no model is right, but some are useful, right? And so we have to make sure that we're using them appropriately. That said, we have a pretty good idea now for many perils and locations about general trends and directions of impacts. And I think those can be really useful guideposts for decision making. And I'll just kind of on your first question, as our tools change, then your premise, I think it is right that our data needs are going to change and evolve too. And so I'll think of one very specific example coming back to the pilot that you mentioned and this idea of a parametric policy. Parametric policies are designed to pay based on some independent, verifiable measure of the hazard, right? So, for example, the New York City MTA has been using a parametric cat bond to provide financial protection against storm damages since Sandy. And they use gauges that tell us exactly how high the water is. And when the water exceeds a certain level, they get a payout. And so that's been used pretty well for river flooding, for storm surge. But what we're seeing now, coming back to the Ida example, is a lot of cities grappling with heavy rainfall flooding and urban flooding that's far from a river and far from the coast. And it's just because there's so much rain in such a short amount of time, it overwhelms the infrastructure. And we don't have good triggers for that yet, right? It's not simply a function of rainfall over time. It has a lot to do with antecedent conditions and the existing infrastructure. And so there is a need to develop kind of new data tools, to new data sources to enable these innovative tools for managing the risk.
Gotcha. And Brian, do you want to weigh in at all, just as far as data sets go?
Yeah, it's a great discussion. You know, how I think of it for our program is not so much in terms of how do we take a model and price the risk, but how do we take a model and use it, to use Carolyn's word, to advocate for an issue in relation to another issue. And we have essentially a fixed pie for funding each year. And when we internally and externally need to make the case to use more of that pie to support affordable housing that responds to the needs we're talking about today, what models are rigorous and validated and useful in making that policy argument. There's a paper that came out over the summer, Taking Stock, Natural Hazards and Federally Assisted Housing. It was really compelling for a number of us and really helped push us and kind of build our confidence in thinking about the value of supporting investments in housing quality, housing location, climate resiliency, and how central that needs to be in our program, and how important we should think about it in terms of which projects should be eligible for our grant funding. So these are kinds of data and kinds of research that I don't think we really would have used in the past in making those value determinations and setting those priorities for our program, but are increasingly so, and we're looking for more of them.
Thank you. And we have our first question from our audience, and this is to everyone. So how do you think about government or other supports that might mitigate the risk faced by an individual? For example, government flood resiliency projects that will come online in 5 to 10 years. Carolyn, do you want to weigh in first?
Sure. I'm not sure exactly the question about what I think about them. I think we have a huge gap in risk reduction measures that we need to adopt as a country. I don't think we've done all the cost-effective risk reduction for today's risk profile, let alone the risk profile we're going to be seeing in the coming years. And I think the kind of the pace and severity of climate impacts already is I think many decision makers were thinking they had longer before we started seeing these types of impacts. So the federal government provides a lot of support for community level investments in flood mitigation. That's through FEMA, the Corps of Engineers, and HUD. A lot of it is post-disaster and tied to specific disasters. But we've seen a shift recently towards trying to allocate more federal dollars pre-disaster, which of course has a lot of benefits in trying to protect people before the disaster actually happens. But of course, the funding for flood risk reduction in the aftermath of a flood is also a really good chance to try to build back better, because once you have destruction of capital and infrastructure, we should be making it stronger and not just putting it back where it was. And that's an important policy challenge going forward, because we have a lot of federal law and regulations in place that were put there for good reasons, but are actually preventing us from building differently after a disaster and building stronger, and then also incorporating other goals we might have, like incorporating energy efficiency and renewables and other things into that rebuilding. So there's some changes I think we need to make to those programs.
Viraj, you want to go next?
Yeah, I mean, I think preparedness is key, right? I think Carolyn's points are well taken. I think we're nowhere near understanding the core risks of today, let alone what happens 5 to 10 years from now. But at least being prepared in some way, shape, or form to be able to address those in a quick manner without the need for long periods of deliberation when folks are in need. So whatever we can do proactively to aid these types of communities and homeowners, and whatever we can do to be kind of, again, prepared for these situations, which are likely to occur at some point in the future, and to be able to release the need as required at the time in an efficient manner will be key. So I think it's less about what the risks look like, but are we set up in a way that efficiently gets the people, gets the help to the people that need it the fastest.
Brian, do you have some thoughts?
Yeah, just about how these solutions, may look different in very different places. Like I said before, our district covers New York and New Jersey, which obviously suffered devastation and loss of life in Tropical Storm Ida. But we also, in upstate New York, all kinds of ice storms, and Puerto Rico and Virgin Islands, of course, saw Hurricanes Irma and Maria in the fall of 2017. And thinking about the risks that extreme climate events pose and that climate change poses on a daily basis to the residents of these places, means thinking about very diverse problems and making sure that the solutions developed at a local level are able to attract the funding and other resources needed to make them successful. So from where we sit, it's really trying to understand not just the challenges, but how local approaches may look different and may need to be served in a different way.
Thank you. And we did get another question. This one is for Viraj. So supply chains are already being affected. As you said before, there are clothing shipment holdups from China and Vietnam because of limited staff working. New York City recently was in the news because there was a problem with shipping containers at the docks. Speaking more tangibly, what companies have been affected by supply chain hiccups?
I think it would probably be easier to list those that have not been affected. I think most sectors, to some degree, have been affected unless, the manufacturing, the majority of the manufacturing happens within that country, right? Obviously, we in the US, a lot of our manufacturing is offshore. I mean, if you look at even car ownership, for example, buying a car today, a used car, you're paying a premium for those vehicles, right? If you're going in to buy something new, you are paying a significant premium today. And that's, completely due to the shortage of both, new automobiles coming through from the manufacturers, but, the inventory of used cars is, due to the fact that there's no new ones available. Used cars are obviously also seeing significant premiums added onto them. So I think all sectors to some degree have been impacted. In the future, I think it's really understanding the concentrations of risks that corporations have and having good mitigation strategies in place. So one of the tools that we're working on is a business relationship score, where we look at corporate. So let's say you're a Ford. Do you have significant concentrations of risk within your supply chain, i.e. one manufacturer line, country even, right? If you've got a lot of your core parts coming from a country, looking at geopolitical risks today, could that have a detrimental impact in the future to that company, right? So we're looking at those concentrations to at least give those corporations some insight into those concentration risks so that they can further mitigate them and ensure they have diverse supply chains that are more resilient to these types of events. Obviously, a pandemic wasn't really a shock that anyone had modeled in to any of our risk frameworks. We had shocks built in from the 2008 housing crisis to the 2001 dot-com bubble and other crises before that. But the pandemic will now be a shock that we look to model into our kind of stress scenarios, and supply chains will be a core component of that.
Thank you. That makes a lot of sense, especially when you say nobody had the pandemic on their bingo card. That wasn't something that we thought would happen in the way it happened. So that really is something that we're going to have to look at going forward. I have kind of a more general question, and I don't want to leave the panel on sort of a negative note. So I'm going to ask it in a way where we can uplift at the end. So what do we see as the biggest risk in your industry in the next few years? And how do you hope that it will be addressed? And why don't we start with you, Brian?
Sure. Again, from where we sit, we're mostly a gap funder in the affordable housing universe. And so we can, take the advice of the two co-panelists today and other industry experts and lean heavily on prioritizing things that address climate and climate impacts on the residents of our district. But at the end of the day, we work in a context of much bigger funders and bigger interests, and the headline numbers only change when everybody's pushing in the same direction. And the risk, I think, really on getting climate consciousness into housing is really that will just mostly muddle through without huge new investment of resources. And again, just speaking in my personal capacity, us funding a handful of projects that are doing passive house or net zero design every few years is not going to move the needle, except for the residents of those individual locations. And we really need, a much bigger and coordinated investment to make that happen and to make it viable and meaningful in the industry. So it's a risk, but it's also the reason that we try to coordinate with our partners at the state housing finance agencies and other big funders to make sure that we're understanding the issues similarly, and we're acting in concert in terms of the kinds of requirements, the kinds of partners we're working with. We're trying, and it takes more money. So thanks, Caren.
Carolyn, do you want to go next?
Sure. If you ask about the biggest risk, I have to step back, and I have to say that the biggest risk that I see is that we don't reduce our carbon emissions. We already can't meet the Paris targets without investments in carbon sequestration. That's taking some carbon out of the atmosphere that's there already. And we're like in real danger right now of blowing past what's widely believed to be safe levels of warning, and the possibilities of what that means, and not just multiple generations down the road, but in our lifetimes and our kids' lifetimes. We're talking about crises around the world that are really worrying to think about, right? Facing inundation and flooding, water stress impacting huge swaths of the population, disruption to food supplies from droughts and pests, public health concerns as disease vectors spread. And we see more heat waves, which are the number one killer in terms of natural disasters, massive migration on a scale the globe hasn't grappled with yet. The role of climate stress in exacerbating political conflict and violence and unrest. There's a lot of research on that recently. Tipping points in systems like the rainforest and the thermohaline circulation in the Atlantic that all are going to have really global consequences. And you wanted to uplift the panel, and I just didn't do that at all. So, but the list goes on, and I have to say I struggle with staying optimistic, because when you see what's going on in Washington right now, we're not doing what needs to be done. And so to get to you trying to uplift the panel at the end, I think what gives me hope is that there are a lot of private sector innovators out there who have really internalized that we need to get to net zero as a globe. And we could do that faster, and maybe we can't do it without, public policy and regulatory structures, but there are people working really hard to get us there. And so I'll put my optimism in that.
Viraj.
Yeah, and to add to the private and public sector, move towards kind of looking at these risks and really being able to understand them, right? I mean, I think there's two areas that I see, and I'll change the lens slightly. I'll make it more focused to the risk that our customers are likely to see, and that inherently through the customer impact there will be consumer impact, right? So I think it's really going beyond the fundamental risk and starting to look at two kind of core other factors. Operational, right? Operational includes ESG risk, right? Includes business relationships risk in terms of key concentrations of suppliers and customers, and include things like cyber, right? Cyber risks today are prevalent as we move to, more automated technologies, right? We move away from kind of on-prem systems and move more to the cloud. These types of events are going to be more prevalent, right? So really understanding the operational landscape of organizations is going to be key to our customers, and having the ability to really understand how to mitigate those risk factors if they do come to fruition, God forbid. I think the other area is behavioral risks, right? Many times, our leaders are the ones setting the direction for governments, for corporations, right? How do these individuals behave, right? Is there some way that we can start to look at people data, right, and turn that people data into a telltale of what the future may hold, right? Looking at maybe behavior in past events or in future events, right? Is there something that we can do there? But to me, I think the operational behavioral risk is going to be key to understand as we kind of, move forward and in the economy and, in the globe as general.
Thank you. I know it does seem grim. I do want to address that. I know it does seem grim, but I feel like it's imperative that we have a little hope. I think
that is the hope, right? Is that we know we need to understand these things better, right? We are building the models, we are building the capabilities to be able to understand these things better. And through better understanding, there can be better preparedness, right? There can be better resilience in local economies and global economies, right? So I think we're moving in the right direction. I think we need to move faster, but we're moving in the right direction.
That's a very hopeful note. Thank you. And thank you, everybody, for being on this panel. This was a wonderful talk. Thank you, Brian. Thank you, Carolyn. Thank you, Viraj. And thank you to everyone in the audience who sent us questions. I have 1,000 more that I want to ask you guys. So okay, we do have one question for Carolyn. What do we do about areas that are repeatedly hit by hurricanes and wildfires? Should we be rebuilding in high-risk areas? Thinking coastal Louisiana, woodland California, can those premiums be affordable?
That is the huge question right now, right? And it's a really hard one. And I think it varies a lot. It's a very place-specific question. There are places where the risks are so high that it doesn't make economic sense to be building there. There are properties in the federal flood program, for example, that we have paid their full value multiple times to rebuild, and that just doesn't make a lot of economic sense. And there are places where the risks are going to be escalating rapidly, and we make long-lived investments when we put down infrastructure or buildings in places. So we need to be thinking about that changing risk profile. That said, that's not an easy thing. It's easy to say that, but there's a number of dimensions to it that are really difficult. One is just people's attachment to place. And it's very hard to come to terms with the fact that communities, particularly coastal communities, are changing and are going to continue to change dramatically in the coming years. And they're not going to be like they were. And we're going to have to face that fact, and we're going to have to deal with the rising water, right? And some of the challenges around wildfire are no less difficult, but slightly different. If you look in California, for example, some of the building in the highest risk areas is deeply tied to the housing crisis, affordability crisis in the state. And so we have to be juggling a whole bunch of different issues at the same time. Maybe my last point on that is that insurance is fundamentally related to the risk. So if the insurance costs a lot, it's because the risk is high. And so the best way to get to affordable insurance is to get to lower risk. And there's a lot we could do even in high risk areas to build safer that would also lower insurance premiums.
Thank you. That was wonderful. Thank you. And on to you, Dakari.
Wow, what a way to wrap up the day. Thank you all so much for joining us. We look forward to seeing you tomorrow at 1 p.m. for the second day of our 8th annual Affordable Homeownership Summit. Have a wonderful evening, everyone. Take care.